Professor Campbell Harvey, probably who does not need an introduction, at least for this crowd. He has been one of the most influential finance academics in the past 20 years, and his research has impacted both academic research and practice of finance. That's a rare combination. He was the president of American Finance Association and the editor of the Journal of Finance, the leading academic journal in this area. And this shows basically the respect that his academic colleagues have for him. He's also a partner and consultant to major asset management firms, which speaks of his influence on the asset management profession. He was recently named 2020 Quant of the Year and #1 LinkedIn Global Top Voice in 2020 for finance and the economy. For the past 7 years, Professor Cam Harvey has taught an innovation and crypto ventures class, which focuses on decentralized finance and blockchain technology, which is a topic of his talk today. His recent book, which I highly recommend, on the future of finance, is, I think, the best source on this fast-moving topic. And the link to his book, which is on Amazon, is on the website for registration. You've already seen it. Cam is joining us from Germany, so we are very grateful that he's taking time from his busy schedule there to give a talk on DeFi, and we are very enormously grateful that he's accepted this invitation to share his thoughts with our students, alum, and friends. Cam, the floor is yours.
Thank you very much. And actually, I'm not in Germany. I'm in Austria. You can see in Innsbruck, just amazing. So thank you for inviting me. And I will talk about my new book. And let me share screen. Let's share. Okay, so hopefully everybody can see this. And what I would like to do is to talk about decentralized finance and really just focus on two things. Number one, what this innovation actually offers in terms of the potential of solving problems. And then number two, I want to talk about risks, because with any new technology, it's really important to understand the risks. And actually in finance, we're pretty good at doing risk management, but this is a little different because there are a number of hurdles that this technology needs to basically get through before it becomes a credible chance to disrupt our current system. So let me kind of start with Jamie Dimon, the CEO of the largest bank in the world. And he always gets a lot of press for this sort of stuff, but he famously called Bitcoin a fraud. And further reflecting on this, Bitcoin is a computer program. So there's no CEO of Bitcoin or head office or board of directors or senior management. So it's really hard to think of it as a fraud. And indeed, he went even further, saying that he would fire any employee trading Bitcoin for being stupid. And I title this Times Have Changed, and we know why, right? So JP Morgan, every investment bank is trading a Bitcoin. Indeed, another thing happened this year, and that was the most successful crypto venture went public, and that is Coinbase, which fetched 85 billion valuation in its market debut. And Coinbase is a centralized company that actually deals in decentralized finance, like cryptocurrency, but extremely successful, and is not the only successful exchange. There's plenty of these. Many people don't know that Coinbase has got a very strong Duke connection, in that the co-founder was a 2010 Duke undergrad. And so Duke was wise to invest very early in Coinbase. And that is a picture of some of my students at the basketball game. But this is just an example of Duke being extremely aggressive in this space with their endowment. So I am not going to talk about Bitcoin. So that's it. Bitcoin is in the news, and other things are in the news, like Elon Musk tweeting about Dogecoin. I'm not going to talk about Doge. So I'm going to talk about decentralized finance and what this innovation potentially can offer. So the very first lecture in my course, I put up this word cloud. And it's an interesting word cloud because many of the words we know, like mint, digest, hash, keeper, fork, like we know these words, but they have special meanings in decentralized finance. At the end of my course, we have a good understanding of each of these words. At the end of my course, my students have a good understanding of actually what they don't know. So we only scratch the surface in this. And my book also is meant to be a book that's pitched at people that are interested in finance, but want to learn more about decentralized finance. So what is decentralized finance? And the simplest possible way of thinking about it is that you're trading peer-to-peer via an algorithm. So it's actually, to me, not that difficult to think about a future where we are basically trading with algorithms. And I'm not just talking about finance. I'm talking about just general interaction, that we will be interacting with algorithms. We already are today to a large extent. So in interacting with the algorithm, you minimize frictions and you don't have this middle layer of cost like our current financial structure imposes. So this is very much about efficient transactions, reducing transactions costs. This is also a technology of inclusion. I will emphasize this at the end, that, that this technology doesn't matter who you are. Everybody is just a peer. So there's no hierarchy whatsoever. So that makes it particularly interesting to me, and I'm going to show you some examples of how that actually plays out. So in DeFi, the space is just evolving, is very early. We're less than 1% into this innovation. But what does it cover? It covers exchange, like I want to buy asset 2 with asset 1. So I send asset 1 to an algorithm and it sends me asset 2. So that's just decentralized exchange. But it's also deeper. There's savings, there's lending, and tokenization, which I will talk about at the end, is an important part of this technology. So all of this happens in a way where it's very interoperable, as I'll emphasize in a few minutes. So number one, what problems does this technology attempt to solve? So if you're looking at a new technology, I think you need to ask this question. And for me, I'd look at a lot of ventures, and I'm not particularly impressed if the venture is supposed to solve a problem that doesn't exist yet. But this technology actually is addressed the problems that exist today. So inefficiency, I'll start with, and I show this in my book. It's an image of one of the very first Western Union wire transfers. And notice it's for $300. And what I really want you to take note of is the fee, 3%. And it's kind of remarkable to me that so little has changed in 150 years. So if I do a credit card swipe, it is 300 basis points of cost. I did a wire transfer the other day to Europe and from my bank in the US. And it was hilarious. I felt bad for the agent, but the agent said, oh, Professor Harvey, you're such a good customer for Bank X. We're going to waive the wire transfer fee. And I said, well, thank you. However, what is the rate that you're quoting for the exchange? And they quoted me a rate. And even though this was a reasonably large transaction, the rate was 2.5% off the market rate. And this is just the way they make money. And 2.5%, 3%, not that much difference. Indeed, in the equity space, to settle a stock transaction takes 2 days. Like, how is that possible? 2 days? It's possible because a lot of people make money from that delay. In decentralized finance, there's no difference between executing a trade and settling a trade. The same thing. So that sort of inefficiency is basically resolved. Number 2 is limited access. And most of us know that 1.7 billion people are unbanked. But there aren't like hard data on this. But I suspect far more are underbanked. And let me give you an example of underbanking. An entrepreneur that has a banking relationship goes to their bank. They've got a great idea. The return on investment, 24%. And they ask the bank for a loan. It's not a large loan. The bank says, I like your idea, but you're small. And we prefer to deal with one larger customer than 100 smaller customers. But given you've already got a banking relationship with us, given you've already got a credit card, we will increase the credit limit to more than cover the size of the loan. So the credit is available, but we know how that works. And it's remarkable how much entrepreneurial activity is financed with credit cards. We know the rate. So the rate could be 24%. And the project isn't pursued. And for me, that friction is really costly for the economy because we've been stuck in this 2% real GDP annualized growth for a long time. And we need those projects that have a 24% return on investment. Yet because of the frictions induced by our current system, that just doesn't occur. It's also the case on the other side, if you're just a saver, it's really hard to save. Indeed, right now, you don't save because the savings rates are far less than the inflation rate. So you put your money in a bank account, you're losing money because the real interest rate is negative. So think of a different system where you don't have the brick and mortar, you don't have the back office staff, you don't have all of the corporate reporting and all of the costs associated with that, but you have an algorithm. And it kind of makes sense that you can offer a savings rate that's larger than zero as a result. And also you can offer a lending rate that's lower than we observe in the banking system. So there's a lot of stuff that's possible that will increase access. Number 3 is opacity, and I just can't help but excerpting this letter from July 26 from Elizabeth Warren, a local senator. And let me just quote this. DeFi refers to a fast-growing and highly opaque corner of the cryptocurrency market. Well, it's clear to me that Elizabeth Warren doesn't understand DeFi, or whoever wrote this letter to Janet Yellen for her doesn't understand decentralized finance, because one unique quality of this space is the complete transparency. So all of the code of these algorithms is open source. Anybody can see it. The balances in the liquidity pools are open for anybody to see. The balances of whoever you're trading with is open to see. So it is completely transparent. And what is not transparent is our current system of banking. So we have no idea when we deposit money at a bank what the financial health is of that bank. We rely upon regulators to do that job. We delegate the monitoring to regulators. So those regulators have a track record that maybe I might use the word of dubious quality. So this space is a different space in that it is completely open. There are barriers right now in terms of kind of understanding some of the details, but that will vanish likely in the future. Okay, centralized control is number 4. And basically what I'm saying here is that the banking system, the stock exchanges, insurance are pretty concentrated. So there's a lot of market power that these firms exert on the market. And that is a lot different than what we see in decentralized finance right now, where you've got a community of stakeholders that are actually using the protocol. They actually have governance control of the protocol to fine-tune certain parameters, and there isn't this concentration that we see in the current system. The last one is the lack of interoperability, and you definitely know about this if you've ever tried to transfer, let's say, money from your bank to your broker. And they said, well, we can do that, but it'll take 2 to 5 days. So even if your broker is associated with your bank, it's not so easy to do that. That instantly can't be done. So within the space, one of the big benefits is so-called DeFi Legos, where all of these protocols fit together. So I can literally go to an exchange, a decentralized exchange, that I have never used before. I can link my Ethereum wallet to that exchange and transact instantly. Okay, so that just doesn't happen in centralized finance. So there are definite problems to be solved, but as careful finance researchers, we always detail the risks. And I will go through some of these risks, and I will focus selectively on some of the more important ones. But the number 1 risk is smart contract risk. So smart contract is this algorithm that resides in the Ethereum blockchain. There are now many competitors to Ethereum that have Ethereum-like blockchains. They also have smart contracts. So for simplicity, I will mainly be talking about Ethereum, but really what I'm talking about applies to many of the Ethereum-like blockchains. So smart contract risk is something that's unique to decentralized finance. So let's think about somebody that's a hacker that wants to get into, let's say, Target. And Target has been a subject of a massive hack before, but the main issue is actually getting in. So it's really difficult to get through all of their security to actually penetrate, get into Target. And then once you're in, you're faced with a massive system that could have millions of lines of code. So in decentralized finance, it is a different system where everything is transparent. So think of the code as it's wide open. So it could be thousands of hackers that are looking at this code and trying to think about a way to exploit it. So this is why I call this a new attack vector, given that the code is for anybody to actually see. And that means it needs to be bulletproof when you post it to a blockchain. So there are many firms that are out there that actually their single goal is auditing. So you pay them, and it could be an enormous fee. It could be $1 million you pay for like 30 lines of code to have it carefully audited to make sure that it is secure. So there's many types of this risk, but let me just highlight a few of them. One is kind of a simple logic error, and it's remarkable how prevalent that is. But the more interesting is an economic exploit. So logic error is something like a contract has got, let's say, 13.999999 ether in it, and then there's a command to pay out 14. So there's a rounding function that goes on. And it turns out that that will fail because there's insufficient funds. So this has to be exact. So even though the contract is short by a fraction of a cent, the transaction will fail. So this is a typical sort of logic error. I think a more interesting sort of situation is an economic exploit. So let's talk about an example of an exploit. So one thing, these contracts are self-contained within a blockchain. Suppose you need to get information from outside a blockchain. So this might take the form of a link. So that link is called an oracle. And in my example, suppose that link is the price of an asset. And suppose that price is grabbed off an exchange that is illiquid. So a reasonable economic exploit would be for the attacker to trade heavily on the illiquid exchange, and that would move the price. And then the main contract actually uses that price as the truth. You transact at that price and then immediately buy or sell somewhere else at a different price. Okay, so essentially you're manipulating the price by exploiting this illiquidity on one exchange. And this provides a type of risk categorized under smart contract risk. So I'll talk about something that's also unique to the Ethereum blockchain constructs called a flash attack a little later on. But this is something that is fascinating for me, perhaps the most fascinating thing for me in this space. So let's actually go through an example of this. So this is an exploit that happened in February. And it is basically a series of steps in a single Ethereum transaction. And this is a complicated transaction in that it's got 161 nested steps. So this actually involves a flash loan to start things off. And I know it's counterintuitive, but listen to the qualities of the flash loan. So the flash loan is a loan that requires no collateral, number one. No identification of the person doing the borrowing. It has zero duration and zero credit risk and a zero interest rate. So that just, for me, I said, you have to be kidding. Like, how can that work? And it has to do with the way that Ethereum transactions actually work. So the transaction that I'm going to show you had a number of steps, but let me simplify it. So the first transaction is you borrow some money. And then that's the first line of the transaction. The second step is you actually deploy the funds in various different protocols. And maybe you identify some arbitrage and you exploit that. And then the very last step of the transaction, you pay back what you borrowed. So if it's the case that any step of the transaction fails, then we revert to the state before anything happened. So suppose you borrow some money in the first step, but the last step, you don't have the money to actually pay back, then the whole thing is canceled and you revert to where you actually began. So this is a property of these smart contracts. They're so-called atomic in that every step has to work or the entire transaction is canceled. or it doesn't actually get approved. So very interesting. And let me show you, every single transaction in the Ethereum blockchain is visible. So you can go onto etherscan.com and you can see everything. And this is, you see at the bottom here, the Yearn exploiter. So they're actually able to label that address as the address of the exploiter. This is a complicated transaction, but let me show you the first line. The first line is to borrow 116,920 Ether. Okay, just think about that. That's $200 million. This could be a 15-year-old kid actually pulling this off. And you can see that there's not one borrowing, but many borrowing below in this transaction. So this is interesting to me because when you think of a $200 million arbitrage, you think, well, a hedge fund can do that. So that's just not open to, let's say, a retail investor. This is open to anybody. So in a way, this really democratizes finance as we know it. So again, this is, it goes on and on. There's 161 token transfers. And some people might call this a hack. I don't call it a hack. This is arbitrage. All of this is wide open. Anybody can do this. And it's available. It's arbitrage at extremely low cost. Another one I want to show you is just recent last month. Well, actually, it's October 1st, so I guess it's August this happened. And this is another smart contract risk example where somebody goes in and drains Poly network of 611 million. So this was the largest exploit in DeFi history at the time. It's interesting, the media called it a fraud. It wasn't obvious to me that it was a fraud. Again, all of this is wide open, so the exploiter can see all of this. And it was hilarious because a conversation began with the exploiter. And the way this happens is not by email, but we know the exploiter's address. So you send them a small amount of Ether with a message, and then the exploiter is sending back stuff. But this is remarkable, the sort of conversation that happened. They said, well, why did you do this? And then the exploiter says, well, I spotted the bug and I had mixed feelings. Ask yourself, what would you do if you're facing so much fortune? So one option is ask the project team politely so they can fix the problem in their smart contract. But anybody on the project team could be the traitor. And given that this is 1 billion, maybe I need a different strategy. I can trust nobody. The only solution I can come up with is saving it in a trusted account while keeping myself anonymous and safe. So this person saw the bug, the person drained the 611 million, and it turns out this person gives back the money. 611 collects a bug bounty of 500,000. And this is turned out well for this protocol, Poly, but it might have turned out poorly if this had been different circumstances. I'm surprised the bug bounty was so cheap at $500,000. I think they should have probably paid more for this. But nevertheless, the message here is not all smart contracts are smart. And indeed, anything with the word smart in front of it, I have reservations about. So there's a number of other risks. I'm going to go quickly through these risks, and because I want time for questions at the end. So governance risk is the situation where usually when these protocols are launched, the developers retain control. So they're not completely decentralized, but then eventually the developers give out the governance tokens to a broader group. But these governance tokens are traded on exchanges. So it's possible that somebody can amass enough control to do something nefarious. And that's exactly what happened to True Senior Edge Dollar, a stablecoin. So the hacker basically amasses governance tokens. The developers had only a small amount, like 9%. The hacker puts a proposal forward to mint him or herself 11.5 quintillion TSDs, and it passes because the hacker has got enough votes to do that. And then the hacker dumps as many as they could, 11.8 billion on a decentralized exchange, and the value of TSD goes to 0. What's interesting, I put these tweets up, but the very last sentence is very revealing. Essentially, the developers say, well, this is sad, it's an attack, but this is how a decentralized smart contract actually works. So if there's a problem, and this governance was a problem, then somebody will take advantage of it, and hopefully people learn from this. I've already talked about Oracle risk, and the Oracle is the window to the outside world, and it is possible that there's a problem with the quality of the data feed coming in. It's also possible that the Oracle goes down, and these decentralized exchanges work 24/7. If the Oracle goes down, then there's basically nothing you can do because the contract cannot execute if there's no input from outside source, the Oracle. Scaling, I'll talk about a little bit. Ethereum and Bitcoin use proof of work, which is very energy intensive. And one of the issues here is just the number of transactions per second. So Ethereum is about 15 transactions per second. Visa is 65,000. So it really can't compete with Visa. So a lot of this has to do with the proof of work. And Ethereum is in the process of switching to a different mechanism called proof of stake. And this is much more energy efficient, and it also allows very significant scaling. So with proof of stake, it should be fairly easy to go to 65,000 transactions per second. There's also other ideas out there. So for example, vertical scaling. So the Ethereum network has got thousands of nodes essentially doing the same thing. A number of other competing protocols, Solana or Algorand, they have a more centralized system, and that allows for them to scale very dramatically. But there's a downside. If you've got one centralized machine, then that is a single point of failure. So what Ethereum is doing is something known as horizontal scaling. And think of this as breaking their blockchain into 64 different pieces, and they're called shards. And then there's a master chain that connects them all. And this dramatically increases the computational ability. And we can get, with this alone, 50,000 TPS. And then finally, there are other proposals, but one that is in the news is a so-called layer 2. And this allows people to do small transactions off blockchain. So there's an on-chain transaction to seed a channel or a multi-signature wallet that's very secure. Then you can trade within the wallet, and then at some point you go back on chain. So potentially you could have millions of transactions within this wallet, but there's only 2 on-chain transactions, one to seed the wallet and one to redeem. So for example, and I told you that some strange noises from around here, that I wasn't going to talk about Bitcoin, but El Salvador actually adopted Bitcoin, and the only feasible way for them to do that would be to have a layer 2 technology where not all of the transactions are on the Bitcoin blockchain. So the scaling problem is a significant problem right now. Transactions costs are very high, but that will be solved. Indeed, I mentioned Ethereum competitors, it's already solved for them. So it's just a matter of time here. So decentralized exchange, this I go into great detail in my book. This is, I think, a remarkable idea where we can trade with an algorithm 24/7, 365. The algorithm doesn't care if you're a buyer or a seller. And there's a formula with automated market makers where you know approximately what you're going to get on the exchange. You see the liquidity. There's also order book exchanges. DYDX, for example, has all of the order book on a layer 2 technology. And then once there's a match, that goes on chain. There's a lot of possibilities here. I know we talk about Coinbase and Binance a lot, but those are centralized. I call them sometimes CDFI, so CEDEFI. These are centralized. They're just regular brokers and exchanges, whereas decentralized finance are algorithms. And already it's the case that the DEX have as much trading volume as the centralized exchanges. So there are risks, of course, associated with this, but this is a very interesting innovation. So custodial risk, we're kind of getting there. That means that somehow your private key is lost. So a private key is just a random number. It's a long random number that nobody can guess. So 256 bits for Ethereum. And if you lose your key, then you lose your Ethereum. And I'm not sure you saw this story in the New York Times this year about a person that basically had a hardware wallet and put their private keys in this wallet that's not connected to the internet and is password protected, but then they forgot the password. And the way that the wallet is constructed, the hardware, if you miss the password 10 times, then the hardware is destroyed. So there's no chance of recovering the private keys. He has tried 8 times and failed 8 times. So 2 to go. So this is an issue, but of course there are solutions. So some of the traditional finance players like Fidelity will offer custody for you, so they will take care of your keys. If you trade with a centralized exchange like Coinbase or Binance, they hold your keys, and it's analogous to a broker holding the stock in the broker's name rather than your name. And there's many companies that just focus on custody alone. So I think that this is an issue today. Many large investment funds have not touched crypto because of this custody problem. They just didn't know how to deal with it. But now, given the main players are involved, it's less of an issue. The 2 more things. Environmental risk is the first one I'll mention. So I say that proof of work is Bitcoin and Ethereum's greatest strength and also its greatest weakness. It's the greatest strength because the computing power behind, let's say, the Bitcoin network is unprecedented. And it means that their blockchain is secure. It means that it is set in stone and it is technologically infeasible to go back and change the history. So that is a great strength where you've got a record that's set forever. But it's also a weakness because the energy use, and this is from University of Cambridge, is enormous. And it's equivalent of a country, a large country like Argentina. And we know that a lot of that energy is generated by carbon unfriendly sources like coal. So I actually did the calculation as to what it would cost to buy a full carbon offset for a new Bitcoin, and it's about $4,000. So that's a lot in terms of carbon. But you need to be careful when you think about that because the coin could be traded, and it doesn't make any sense to tax every transaction $4,000. And then the other complicated thing is that there's 18 million Bitcoin out there, but maybe 14 million were produced when the energy need was trivial. So maybe the carbon offset for the first 15 million might be less than 10 cents a coin. And all of these coins are fungible. So some things to think about. Nevertheless, I think that the environmental risk will be mitigated for Ethereum when they move to proof of stake. And proof of stake is a very simple idea that instead of having thousands of miners working on the same problem, you have miners putting up stake. So they actually pledge some Ethereum. And let's say a miner has pledged 10% of the overall pool, then probabilistically they'll be chosen to do the block 10% of the time, and they get rewarded for that. And if they do anything nefarious, if they start approving transactions that they shouldn't approve, then their stake is slashed. So it comes right out of their stake. So it is incentive compatible and again, very energy efficient. Bitcoin, on the other hand, it will never change. It'll always be proof of work, in my opinion. And the best we can hope for is something like what happened in China, where the mining was banned. And hopefully we see the mining migrate to countries that have locked clean energy, like Iceland, where Iceland's got unlimited, cheap, clean geothermal power, but there's nowhere that they can export it. You can't drop a cable from Iceland to northern Scotland. So it's just not technologically feasible. So I do think that this will be mitigated. So regulatory risk is obviously a big deal. So DeFi in particular is in the crosshairs of the SEC. Many of you probably followed what happened with Coinbase because they were going to offer a 4% savings rate. And maybe somebody will ask a question on that. They had to withdraw that. Notice the SEC goes after Coinbase because it's a centralized company. Right? So they've got a CEO, they've got a board of directors, they have a headquarters. It's much harder for the SEC to give a Wells notice to an algorithm. So the regulator, they got a tough job. And I've talked to these regulators, they fully understand the trade-off. So they're there to protect consumers. But they know if the regulation's too harsh, then they will drive innovation either offshore or destroy the innovation entirely. So it's really difficult because the regulator needs to learn the technology, which is complicated, and they have to keep up because it's so quickly changing. So there are a lot of hurdles here. I think that there will be regulatory clarity in the next couple of years. Right now, we're in limbo. Obviously, the Securities Act of 1933 doesn't mention decentralized finance or cryptocurrency. So we need to work this out. And I do think it'll be helpful in the end because this regulatory limbo is not particularly helpful. Companies will guess what the regulators are going to do, and therefore we need to set up in the Cayman Islands, for example, rather than the US. So clarity, I think, will be forthcoming. So let me conclude. I see lots of questions. Let me conclude by arguing that the model that we've been operating in hasn't really changed over the past century. So the commercial banks, central banks, stock exchanges, brokers, insurers, they're largely the same names. So there is digitization, that's true. But the infrastructure is basically the same. And this is important. The current wave of fintech just improves upon centralized finance, but it uses the infrastructure of centralized finance. So it's great in that transaction costs are reduced. And some of the fintech has done really well on that. But let me quote a speaker in my class who happens to be the co-founder of Coinbase and co-founder of Paradigm. And he said that the current fintech, like Stripe and Plaid, is like putting lipstick on a pig. And basically the point that he's making is that the current fintech, given the limitation of using the centralized financial system, can only go so far. So those costs can be reduced only so far. And then after that, you need to go to decentralized finance, where you're literally matching peers via an algorithm. So even today, so I said that we're less than 1% into decentralized finance, but it is remarkable even today, if you look at the capitalization of global banks, so not just US banks, global banks, and what's happening in the crypto space, it is almost at the point right now where you've got a similar capitalization. So let me end with a quote from Tim Roughgarden, is a computer scientist that I respect a lot at Columbia. He is teaching a blockchain course, which I highly recommend. It's a great course, and I basically grabbed this from his opening lecture. And it's kind of interesting in the lecture. He argues that his course kind of cuts through the hype of this space. And hopefully you see that that's what I'm trying to do also. In my book, I devote a huge amount of space to the risks that this technology faces, to give this a balanced perspective. But at some point he says, okay, just a little bit of hype. And I've underlined what he says. Future generations will be jealous of your opportunity to get in on the ground floor of this new area. So that is pretty powerful. And he's not just talking about making some investment. He's talking about developing new ideas. And for us, it is basically think about the research opportunities here. That if it's true that centralized finance is replaced by decentralized finance, that opens the floodgate for many new research projects. And I'm not talking about research projects that study the volatility or fit some Garch model to Bitcoin. That's not what I'm talking about. There's plenty of researchers out there right now that are aiming low, in my opinion, in terms of what could be done. I'm talking about something much bigger, that there is this possibility of disrupting the banking system as we know it. Indeed, the central banks are scrambling. They're basically trying to do the central bank digital currency as a result of the growth of cryptocurrency. In my opinion, the money supply is out of their control already. The horse has left the barn. And it's not clear what they can actually do about it unless you're in a country like China, where they can do whatever they want. And they can impose a central bank digital currency where the central bank can tax arbitrarily, delete you, know every single transaction. They can maybe do it there, but I seriously doubt they can do something like that in the US. So there is a big opportunity here. And the way I look at it is that I see the scaffolding of a new city. And it's really key to understand that this is not a renovation. This scaffolding represents a complete rebuild from the bottom up. And the last thought I will leave you with is the first sentence in my book is we've come full circle. And what I mean by that is we started with a market exchange thousands of years ago that was barter. It was very inefficient. And then money basically made exchange much more efficient. Now we have the capability of returning to barter, but in a much more efficient method. With decentralized exchange, there's many different ways that you can pay for things in exchange. Indeed, in my vision of the future, everything will be tokenized, whether virtual or physical. It will be tokenized and reside on some blockchain. There will be millions of blockchains, if not billions. And this will just be the way of life. In 15 years, I believe that the financial system will look shockingly different than it is today. And our job as academics is to think about the long term, to write papers that will have impact in the long term, to teach our students about a vision of the future to help them prepare for what is oncoming. So at this point, I will pause and take questions. And let me stop the share.
Sure. Well, thank you so much, Cam. Fascinating talk, and as you can see, there are lots of questions there. So let me start with something that my colleague Sanjay mentioned at the beginning, and I'm going to paraphrase it. How important is this decentralization to this whole new system? In other words, it seems that at least right now, a centralized network would be much faster, and maybe to some extent could do everything that basically this decentralized system is doing, maybe even at a lower cost, carbon and so on and so forth. So is it possible at some point some organizations will get together, or central banks, and create sort of a centralized system?
So the question's a good question. And let me answer it in the following way. Even the banks realize that some of these ideas are excellent ideas. So JP Morgan, even though Jamie Dimon was very negative on cryptocurrencies, they were busy being the world leader in applying blockchain technology in terms of what they do. So they can internally do a stable coin that they could use to do transactions much more efficiently, saving money for them and saving money for their clients. So that's just an example of using some of this technology in a centralized way. My course is not just about finance, it's about blockchain in general. And basically I tell the students, you need to pick the particular situation, the problem that you're trying to solve. And it might be that a centralized system is much better. So we already trust Walmart in terms of the goods that we buy. Walmart can improve the efficiency of their supply chain with a blockchain that is centralized. So you don't need to decentralize that. It can be very fast and very cheap to actually do. So in finance, it's a little different. The traditional banks will use centralized distributed ledger technology for some things. But at some point, there's a limit in terms of how much can be saved. And what's the most important thing, in my opinion, is to drive these transactions costs as low as possible. As economists, we know that there's very few things that we agree upon. But one thing that we do agree upon is that lowest possible transactions cost is good. It's good for people that are transacting. It's good for the economy. So if you want speed, there's various different ways to do it. And I already mentioned that there are some technologies like Algorand that use a more centralized technique to verify transactions and do their blocks. But there's other ways of doing it that are more decentralized. So the world I see in the future is not a binary situation, like centralized versus decentralized. It's a continuum. And we need to just focus on what the most logical application actually is. My students propose ideas where they need to demonstrate that a decentralized technology is the optimal technology for that particular application. So it's a good question. In finance, in particular, I think that there's a lot of benefit to the decentralization in that it does hold the possibility of driving the cost to zero and to be very inclusive. So good question.
So right now, I mean, most of the DeFi is basically crypto sort of world. In other words, it has little connection to the real assets. And it seems to me that for that connection to take place, trading shares of Apple or building, you need regulation. Would that regulation make the interoperability sort of go away, because each country is going to have its own regulation and probably its own blockchain, so they're not going to be able to work sort of across countries?
Yeah, so this idea of having like a country having blockchain that doesn't work if it's decentralized, right? So again, it's really hard to think, look, you've got an algorithm that might be on a number of nodes in the US, and the regulator is trying to put that algorithm out of business. How do they do that, right? Because even if you shut down all the nodes in the US, you've got thousands of nodes outside the US. So it's really difficult to do. But on the regulatory side, I was on a Zoom thing that NYU did the other week, and one of the speakers was from Davis Polk, and she said something very insightful. She said that some regulation actually will be very helpful for this space. And the analogy she gave was a highway. So we actually have lanes painted on the highway, and we have clear markings for exits and entrances to the highway. And that regulation actually allows cars to go faster on the highway. So the case is that some regulation is necessary. We need to be careful in doing it. We don't want it to be too harsh. But in terms of the tokenization, it will be that companies will just issue tokens. So we won't have the same construct, the NYC or NASDAQ. In decentralized finance, even today, there's thousands of different trading venues for the same thing. So that can be done virtually. Physical assets need to be housed. So it is inevitable, some centralization. So if you have a token that's based on gold, then that needs to be stored somewhere. The popular stablecoins like USDC and USDT, those are centralized. So those don't qualify as decentralized finance. Those are companies running those stablecoins. They are used in decentralized finance. But if you want a decentralized stablecoin, you need to go to MakerDAO's DAI, or Fei is another example of a decentralized stablecoin, which I like much better than the centralized ones. So again, there's a lot of choices here. It is so early on that it's really hard to tell exactly where this is going, but the regulatory uncertainty is very significant.
Mm-hmm. One part you just mentioned, that stable coins. What's your view on that? Some Fed officials have said, it poses a grave risk to the economy. What is your take on the stable coins?
Yeah, the current banking system poses the grave risk to the economy. Come on. So we lived through that in the global financial crisis, where these banks had leverage that was not transparent to the average person, extreme leverage that supposedly our regulators were on top of, but I guess not. So that is a risk. So think of these tokens, and not just stablecoin is not just a US dollar token. The gold token, it could be a stablecoin also. It's just something that's collateralized. So there was a period actually in US history, the free banking period, where banks issued currency. And they were backed by, let's say, silver or gold or US bonds or even equities. So this is nothing really new. Does it pose a systemic threat to the economy? Well, I'm just not sure, because in the way I look at this is a globally diversified system in decentralized finance. So the risk is spread much more efficiently around the world. So I think that, of course, there are some issues. Indeed, USDC, which is owned by Circle, has got this scheme. I'm not sure many know about this, but they've applied to be a bank. And think about their problem. They've got one for one. They've got dollars for every token they've issued. But what do you do with the dollars? So you can buy some treasury bills, but then you need to maybe deposit at a bank. And if the bank fails, then you break the buck. And the banks have failed in the past. So what do you do? And what they want to do is they want to apply to be a bank, and they want to be a special kind of bank called a narrow bank. So most banks, you make a deposit, you send some reserve to the Fed, and then you lend out the residual. A narrow bank has got a different model. You make a deposit, they send 100% to the Fed. That's all they do. So if you think about that, what that would create is the central bank digital currency de facto. And the Fed effectively backing it. So the Fed will try to block this. They definitely don't want this company to preempt, but you get the idea here. So I think the stablecoin space is a very interesting space, and I have been positive on it for the last 4 years, actually. I remember having the Circle people just like the week they launched in my course. So I think it is a very interesting technology.
Speaking of digital coins by central banks, you think that's why China is sort of coming down hard on cryptos, because this is a preamble to launching their own cryptocurrency?
Yeah, so the problem in China is that they're worried about capital flight. So there's a lot of very rich people in China that want to get their money out of China. And there are regulations right now in terms of how much you can move offshore every year. And it's a pretty minor amount. So this is a major threat to them, because the idea is the Chinese citizen would just invest in a cryptocurrency and then just move it. And indeed, they don't even need to move it, right? Because the currency, if you've got your private key secure somewhere, it resides on thousands of ledgers all over the world, right? So there's no transfer that's actually necessary to do this. So China did the right thing in banning the mining, of course. Now they're trying to ban the transactions. It's still legal to hold the crypto, but you just can't transact with it. So I understand their motive. I understand that central banks will oppose this. Central banks have realized that, oh, this digital currency idea is a great idea because we can efficiently tax, right? So like the value-added tax in Europe is a joke, right? Because you pay people cash and avoid whatever 17% tax. So if you didn't have that physical cash, then you can get around the VAT. So no physical cash, you must be taxed. So the government can do whatever tax they want. So it's great for tax collection. And also, if you want to impose negative interest rates, you can do that at will, because the zero lower bound doesn't apply because there's no cash. But the downsides are that the government potentially sees all transactions. The government can edit you, they can remove all your funds. So I think that is a pretty serious downside. So all central banks will have some sort of digital currency. It's kind of obvious that we won't be using paper currency in 10 years. That's kind of obvious, right? Books and the hard copy of the Journal of Finance, no. It just doesn't make any sense in the future. But I do think that, as I said earlier, it's too late. That given we've got this technology now, that there's just too many ways to compete against the central banks. So they've lost control. They'll try to retain control. They'll fight. The banks, the commercial banks will fight. One of the major banks announced recently that they had more blockchain patents than any other company in the world. And I just laughed at that, because the whole idea of decentralized finance is that it's open source. It works very efficiently, open source. So you've got a smart contract that is the foundation for a protocol. And somebody thinks of a way to make a slight improvement on that protocol. They copy the code, which is wide open. They add a few lines to improve it, and then they launch. And you can launch within a week. Can you imagine you're dealing with your commercial bank, and you do the online banking and you see some possible improvement in the way they present it, how long would that take to actually happen at your bank? And could you start up a new bank within a week? So this space, basically this idea of forking I talk about a lot, that you can take the code, improve upon it, and launch a competitor very quickly. You can also jumpstart your business by offering rewards. So some of these very high savings rates are not really savings rates that are offered. So there is a savings rate for providing liquidity, but often these protocols are giving rewards in terms of their token to incent people to actually use the protocol. So it's kind of like you go into your Apple store to buy a new iPhone 13 and you're rebated some Apple stock when you do that. So again, it's really easy to do that in this space, and those incentives are always available. So it's a unique aspect of the space.
One question regarding this decentralization and how decentralized some of these protocols are. I was reading about Uniswap, and as you know, there was Uniswap version 1, and now there is Uniswap version 2. And as you mentioned, to make changes in some of these protocols, you need governance, people who hold the governance tokens to sort of vote on it. In this case, they didn't vote on it. They just said, we're going to keep the 1.0, but we're going to introduce this new one, but we're going to stop supporting 1.0. I mean, that sort of flies in the face of decentralization. I mean, this is one example of it. So, I mean, to what extent is it really decentralized, some of these protocols, when they rely on developers?
Okay, so just to be clear, what we're talking here is version 2 of Uniswap. And then they introduced the version 3, which is a significant improvement on the version 2. So the version 2 uses what's known as a constant function automated market maker, and there are some limitations to that. There's some risks that are associated with that, and in particular, impermanent loss, which I deal with in my book. So version 3 is much more like a limit order book, where you provide liquidity in a particular range. So it's a much better idea, but the version 2 exists because it's out there. So this is the key thing. So most of these Uniswap constant function market maker, it's an algorithm that's deployed to the Ethereum blockchain, and there are no parameters to fine tune. So it's there forever. So you can't withdraw it. It's just there. So if people want to provide liquidity to it, they get a small fee for actually doing that. There's a small trading fee that goes to them to cover that. So they can do that, but it's there forever. So you can't withdraw it. So you can do something different by adding a version 3, but the old version is there. Now, there's some other protocols in decentralized finance that allow for the fine-tuning of certain parameters. So that might be the savings rate. That might be the collateralization ratio. If there's kind of like a savings and lending going on in the protocol. So the governance will actually vote on those parameter changes. So again, the version 2 that you talked about is just a computer program that's completely decentralized. So your peers interacting with that algorithm, and that's it. And then you've got this different model where there's certain parameters that you can change with the governance. And it's also interesting, suppose that the governance, let's say, votes themselves a dividend. And people say, well, they shouldn't do that. So I'm going to fork that protocol, and I'm going to do everything they're doing except the dividend and try to attract business. So if you do something self-serving, then you're going to get forked. And effectively, liquidity will flee from your idea to something else. So this is decentralization, and different protocols have different rules as to what majority actually means. And the actual consensus is, I think, a matter for research. that we can do in financial economics. So one thing with this space that's interesting is that it is the confluence of known techniques in computer science. So blockchain is not a new idea, 1991 idea. And distributed protocols, again, well known in computer science. And then you merge that with game theory and financial economics, and you've got something completely new. And one issue traditionally, and traditionally the space is so young, has been most of the innovation coming from computer scientists that know little about finance, and like the Satoshi Nakamoto white paper. And this is, I think, on one hand, good that they have a completely fresh perspective, but on the other hand, there's a lot that we can offer. So I really encourage, especially my colleagues that are more theoretically oriented, to jump into this space. There's just so much that can be improved upon with an economics foundation. So it is exciting to actually be involved at this stage in this innovation.
Two of my colleagues have raised their hands, they have questions, but before doing so, I want to make an announcement. I forgot to do it at the beginning. I'm the editor of Journal of Alternative Investments, along with my colleague Bing Liang and Mila Getmansky, and we're going to have a special issue next year on fintech. So people who are listening, who are probably interested, of course, in this topic, you're welcome to submit your paper to Journal of Alternative Investments. We're going to cover cryptos and DeFi and related areas. So having said that, I think Bing has some questions. So Bing, you want to go ahead? You're allowed to talk now.
Yeah, can you hear me?
Yes.
Yes.
Yeah. Hey, thanks, Cam, for the nice talk. And just bought the book from Amazon.
Oh, that's great. That means a profit of $1 for me.
There we go. I got a question about, this like arm twisting between the private sector and the government, right? So it seems the private sectors like asset managers, hedge funds, all picking up the game, but governments are still starving. So what will be the impact of this arm twisting, number one? And number two, for China, they're banning the mining business and call them to migrate it to the low-cost countries. People talk about Venezuela, So environmental-wise, it's not safe, and political-wise, probably it's not safe either, right? So there's another impact for the industry. Given the arm twisting, so there are all kind of like an uncertainty for the future of this industry. What do you think about the future?
Yeah, so I guess in my opinion, it's not enough to just have a great solution for a problem, especially when it comes to blockchain technology. You need to assess the strength of the middle layer. And in certain industries, the middle layer is really thick and very powerful. The example I use is digital music. So there's so many middle layer players that if you're an artist, it's trivial what you make from releasing, let's say, a song. And it's really an ideal application of blockchain technology, but the middle layer is so powerful that it's just so difficult to get through. In finance, I think that we're kind of at the stage that Bitcoin has kind of become more accepted as a potential asset out there, and large investors have actually considered some exposure to it. Again, I'm not as interested in that. I'm more interested in what's happening at commercial banks and exchanges and things like that. So as I said, yeah, there will be a lot of heavy lobbying pressure from central banks to slow this down, to regulate. I think that that's just inevitable that they will fight. But I also think that they understand the future. I was invited to go to a special session for one of the largest exchange groups in the world. And it was a vague invitation. will you come up and talk to us about crypto? I said, yeah, sure. Given who you are, at minimum, I should be able to tell the story to my students. At maximum, maybe a conference like this one. So I get there with basically no agenda. I'm at this giant table with the board of directors and all senior management. And they had a single question: how long do we have? So they'd already figured out that it was just a matter of time where these traditional exchanges are just going to be completely disrupted. And they want to know how much time. And we've seen this in other industries with technological change. And I think the banks understand this also, that they just won't be needed in the same way. So some will survive, but it'll be a completely different business model. So in the short term, there's going to be a lot of regulatory fights. There's going to be legal stuff. There's going to be lobbying. But what is at stake here? I remember when Ben Bernanke was chair of the Federal Reserve, and somebody asked him about cryptocurrency, and he said, "Well, it's interesting, and in my opinion, anything that has the potential to reduce transactions costs should be considered very carefully." And that's exactly the answer of a skilled economist like Bernanke, that there's just so much at stake here. And we do need this upside, just a minor diversion. Given, and this is not just a US thing, but many countries in the developed world, we've taken on a lot of debt. And you can pay that debt back in 3 ways. Number one is to raise taxes, which nobody wants. And it's really hard to do politically. Number two, to print money, which causes inflation, which is like a tax. And number three is to grow. And it's like we've accepted this 2% real GDP growth. And I think that if we reduce the frictions, we've got the possibility of jumpstarting growth. Indeed, my research is supportive of that. My paper on financial liberalization in particular shows what happens when you reduce those costs in terms of economic growth. So I do think that this is really important to put us on a path. I think we all want to operate more efficiently. And yes, there's going to be issues. There's going to be people taken advantage of, Ponzi schemes, there'll be some illegal activity, all this stuff. This is just part of the risk of a new innovation. So any new technology's got risk. You want to eliminate all the risk. You want to do harsh regulation to eliminate all the risk, then you might as well invest in treasury bills. So this is the technology, again, it's early days, and the road will have many ups and downs.
Thank you, Cam. One last quick question from Sanjay as we are running short. So Sanjay, the floor is yours.
Hi. So I have a kind of a basic question about what would happen if is there a risk of hyperinflation that could arise if there's some event which basically makes us lose confidence in the dollar, and then let's say there's some speculation in Bitcoin and some of the other currencies, and then because this is happening at such a large scale, it would beat any other mania that's happened in the history, and it would just become an easy way to make money. Just keep betting it, and that just if you multiply, say 10 million per Bitcoin times 21 million, that is 210 trillion. So it's just in theory we say limited supply, but what is limited if you don't have any value that grounds that currency? We don't know whether it's worth 50,000 or 200,000 or a million.
Yeah. So look, I agree with you. So some people think that Bitcoin's worth zero. And again, my book is not about Bitcoin. My class is not about Bitcoin. And some people do this calculation that, well, Bitcoin equals gold. There's 9 trillion of gold. There's 21 million Bitcoin. So therefore, each Bitcoin's worth 400,000. So we know that that is faulty logic. given you assume the result in the first step. So you're right that it doesn't have value. What I'm talking about in terms of tokenization is different. So Ethereum actually has value directly. It is a virtual machine. It allows you to do computation, just like Amazon Cloud has got value. Ethereum has value. And many of these tokens, we talk about crypto very vaguely, and we're thinking about Dogecoin and Bitcoin, blah, blah, blah. Many of these tokens have value associated with them, that they represent liquidity in a pool, like a share of liquidity. They could be stable coins that are linked to a currency, like the dollar. They could be linked, as I said, to gold or to stocks. So there are cryptos with tangible value. There are cryptos with intangible value. So again, these are all, in a way, competitors to the central banks. Look, it's actually one country that's really interesting, given you mentioned hyperinflation, is Venezuela. So Venezuela's got hyperinflation, it's 700% per year. So it's no big deal if you're rich in Venezuela, because you got a bank account in Miami in US dollars. So inflate away, your dollars are secure. But the average person in Venezuela gets hammered. They don't have the bank account in Miami, but they have a smartphone. And the smartphone is their bank. And if they want to dollarize, no problem. They can hold USDC, a stable coin linked to the US dollar. So you think about what's happening there. The rich have basically taken their money offshore and have dollarized. Everybody else with a smartphone can do the same thing at low cost. And you've disintermediated a central bank and a government that's got a reckless monetary policy. So again, I think my vision is that central banks play a far less prominent role in the future. It will be a challenge to figure out how the government can efficiently tax people in this world. But I think that, again, it's too late. So I don't speculate as to what the true price of Bitcoin should be. Who knows, right? So I have no idea. It does have some intangible value, but I have no idea what it is. I'm not a speculator in Bitcoin, but what I focus more on are the protocols that actually do something.
All right, well, thank you so much, Cam. I know it's been a long day, but we really appreciate that you took time and gave us this fascinating presentation.
Yeah,